Income tax. Income tax is a percentage taken from the money people earn through work, business, or investments. Governments collect it directly from individuals and companies to fund public services like schools, healthcare, infrastructure, and defense. The amount someone pays usually depends on how much they earn, with higher earners often paying a higher rate. In many countries, income tax became common during the late 19th and early 20th centuries as governments needed stable revenue to support growing public systems. Sales tax. Sales tax is added to the price of goods and services when people buy them. The tax is collected by the seller at the point of purchase and then passed on to the government. Because it is tied to spending, people only pay sales tax when they buy something. Different regions often apply different rates, which is why the final price of the same item can vary from place to place. Property tax. Property tax is charged on real estate such as land, houses, and buildings. Local governments usually collect it based on the value of the property. The money raised often goes toward community services like local schools, police departments, and road maintenance. Because property values change over time, the amount of property tax a person pays can rise or fall depending on the market. Corporate tax. Corporate tax is applied to the profits earned by companies. After a business subtracts its expenses from its revenue, the remaining profit becomes taxable. Governments use corporate tax to ensure businesses contribute to the public systems that support the economy they operate in. Rates and rules vary widely between countries, which sometimes influences where companies choose to base their operations. Capital gain tax. Capital gains tax applies to the profit made when someone sells an asset for more than they originally paid for it. Common examples include selling stocks, real estate, or valuable collectibles. The tax only applies to the gain, not the full sale price. Many governments treat long-term investments differently from short-term ones, often offering lower rates for assets held over longer periods. Value-added tax. Value-added tax, often called VAT, is charged at multiple stages of the production and distribution process. Instead of being added only at the final sale, each business in the supply chain pays tax on the value it adds to a product. By the time the item reaches the consumer, the total VAT has already been built into the final price. This system is widely used across Europe and many other parts of the world. Excise tax. Excise tax is placed on specific goods, usually products that governments want to regulate or discourage. Common examples include tobacco, alcohol, gasoline, and certain luxury items. These taxes are often included in the product's price rather than listed separately. In addition to raising revenue, excise taxes are sometimes designed to reduce consumption of harmful products. Inheritance tax. Inheritance tax is applied to wealth or property passed from one person to another after death. The tax may be paid by the estate before the assets are distributed or by the person receiving the inheritance, depending on the country's rules. Supporters argue that it helps reduce extreme wealth concentration, while critics believe it places a burden on families passing down property. Payroll tax. Payroll tax is taken directly from wages to fund social programs such as retirement pensions, unemployment benefits, and healthcare systems. Both employees and employers often contribute a portion of this tax. Because it is automatically deducted from paychecks, most workers pay it without needing to calculate or submit anything themselves. The funds collected are typically reserved for specific government programs rather than general spending.